For more theory videos, visit my website. If you find this video helpful, please let me know. What is an organization? What is meant when we say organization? We all know of organizations and understand what they are, but what is the technical definition of an organization? One definition for an organization is a social arrangement that is structured and managed to pursue collective goals. It controls its own performance and is an open structure which is affected by and can affect its environment. Let's break this definition down. Social arrangement. By this we mean the organization is made up of people. The social arrangement refers to how people interact with the organization and with each other. Structured and managed. This refers to the hierarchy of an organization, its command structure. Collective goals. These are the organization's objectives, its reason for being. Controls its own performance. Here we can reference cost and management accounting. Management accounting monitors actual results against objectives and goals and feeds back this information for improvement. And finally, it is an open structure. An organization is affected by inputs and can affect the environment by its outputs. All organizations, no matter what size, will need some form of office, from the small sole trader who may use a laptop or a simple filing system to the large-scale organization which may have many different departments working on the administration and record-keeping of that organization. An organization's office performs the function of information management. It receives, records, arranges, analyzes, and supplies information. The function of the office. The basic routine functions of an office are to receive, prepare, and collect information. Information can be received internally from the various departments, for example, memos, or externally, for example, purchase invoices. This information is required by management for the running of the organization, and this is why the office collects it. For example, financial information is required in order to produce the accounts. Secondly, to process and arrange information. This is the most significant function of the office. Information received cannot readily be used for decision-making and therefore must be prepared, edited, and arranged in a systematic way. Thirdly, to supply ready-made information to management and authorities. The office receives and prepares information. It processes and arranges this information into usable forms, and it then supplies this usable information to the relevant managers, employees, and authorities, as and when the information is required. And finally, retention of records. Efficient offices preserve records for future use. This can be done manually through filing paper records or electronically by maintaining computer files. Every record has a lifespan and is protected according to its importance. Types of organizations. Business organizations come with different legal structures. The types of organizations we are going to look at here are commercial organizations, cooperatives, not-for-profit organizations, public sector organizations, and non-governmental organizations. Examples of commercial organizations are sole traders, partnerships, limited companies, and limited liability partnerships. A sole trader is a company started and run by one individual. It is a business owned and ran by one individual with no legal distinction between the owner and the business. A partnership is an association of two or more persons to carry out as co-owners of a business for profit. Legally, a partnership is regarded as a group of individuals rather than a single entity. No legal formalities are needed to form a partnership, although most partnerships will have a partnership agreement. A limited company is a company with separate legal identity from its owners. For shareholders who are the owners, liability is limited to the amount of money invested in the company. A limited liability company has separate legal identity, which is very different from sole traders and partnerships, where in the eyes of the law, the owners and the business are one and the same. Limited companies vary in size, from a small company with only a few shareholders to large quoted companies which operate worldwide and who have a great many number of shareholders. The company's owners have what is called limited liability, in that the risks of ownership are limited to the amount invested in the company. Owners can lose their investment, but unlike sole traders and partnerships, they cannot be forced to make further contributions to the business to make good any further losses. A limited liability partnership is a partnership in which some or all of the partners have limited liability. A limited liability partnership exhibits elements of a partnership and a limited company. It is a separate corporate body in that it continues legally to exist independent of its members, whereas partnerships have no separate legal identity. Limited liability partnerships have the letters LLP after its name. In a limited liability partnership, members or partners have a collective responsibility limited to the amount invested in the partnership. A limited liability partnership is commonly used by accountants. Cooperatives are organisations that are owned and run by people who buy and use their services, and who share in the profit and benefits of the cooperative. A not-for-profit organisation is a type of organisation that does not earn profits for its owners. Money earned by or donated to a not-for-profit organisation is used in pursuing the organisation's objectives. The main differences between a not-for-profit organisation and other forms of business previously talked about is that a not-for-profit's main aim is not financial. Like its name suggests, the goal of the company is not to make a profit, rather to achieve set objectives. The main types of not-for-profit organisations are associations, charities, and voluntary organisations. They are formed to further cultural, educational, religious, professional, or public service objectives. Startup funding is provided by members, trustees, or others who do not expect repayment or returns, and do not share in profits or losses of the organisation. Public sector organisations are owned and controlled by the government. They are set up in order to provide a public service, often free at the point of delivery, for example, police, education, healthcare, and so on. Non-government organisations are organisations that are neither a conventional profit-seeking organisation nor a government-controlled organisation, although non-government organisations may be funded by governments. Some good examples of non-government organisations are UNESCO, United Nations, and Greenpeace. Planning levels. There are 3 levels of planning: strategic, tactical, and operational. Strategic planning is an organisation's objectives and strategies. Objectives is where an organisation wants to be, and strategies is how an organisation intends to get there. Strategic planning is done at board level. It is long-term planning which considers the whole of the organisation, matching an organisation's activities to the external environment, identifying future requirements and matching that to resources and capabilities. With strategic plans, there is a high degree of uncertainty. Organisations should have controls in place to monitor strategies, to see how well objectives are being met, and to recommend corrective action if required. Tactical planning is more specific planning, done at middle management level. Tactical planning is medium-term planning. It's concerned with the management and use of existing assets, resources, and capabilities. Tactical plans need to be aligned to strategic plans. Operational plans are the day-to-day plans for the running of the company, given the existing strategic direction. Operational plans are carried out by junior management. They do not tend to change an organization's strategy. Instead, operational planning is detailed short-term planning, which is unlikely to involve major elements of uncertainty. As you saw before, objectives is where an organization wants to be, and strategies is how an organization intends to get there. There are 3 levels to strategy: corporate, business, and operational. Corporate strategy is concerned with the whole of the organization. Business strategy is how to approach a particular market. An operational strategy is strategy that is specific to each department. The main functions of organizational departments. Research and development looks at developing an organization's internal processes and at the improvement of products and services. Purchasing. This is what the organization does to get the resources it needs to operate. This includes finding vendors and negotiating best trading terms with regards to quality, quantity, and price of input materials acquired. Production is the converting of raw materials into finished goods, adding value in the process. Service department. Customer services deal with customer inquiries and complaints. Administration provides the back office support for the organization. Finance provides the financial reporting and management accounting requirements of the organization. Human resources. Human resource management is how well a company recruits, hires, trains, motivates, rewards, and retains its workers. People are a significant source of value, so businesses can create a clear advantage with good human resources practices. Marketing is responsible for product pricing, distribution, and promotion. Marketing is the process you use to persuade clients to purchase from you instead of your competitors. This can be done through product orientation, which is producing goods of very high quality in the hope that this is what customers want. Sales orientation, which is the use of aggressive sales techniques used to persuade customers to buy. Or market orientation. This is where an organization aims to satisfy the needs of their customers, thus encouraging sales. Marketing mix refers to the set of actions or tactics that an organization uses to promote its brand or product in the market. Marketing mix is a balance of the 4 P's: product, price, promotion, and place. These 4 elements are adjusted until the right combination to satisfy customer needs is found. Product is anything that satisfies the wants and needs of the customer. It refers to designs, features, and packaging of a product. Price, for example, are the discounts, credit policies, and payment terms offered. Promotion is the advertising and marketing of the product or service. It includes all marketing communications. And place. This is how the product is distributed. It is the distribution channels, transportation, and warehousing of products. With the service sector, this becomes the 7 P's. The extra elements being people, physical evidence, and process management. People are the employees providing the service. Physical evidence. Services are intangible, therefore physical evidence can serve as a marketing tool. For example, the layout, decor, and presentation of the service. Efficient process management can become a marketing advantage. For example, how well a customer is handled from the first to last contact. For more theory videos, visit my website. If you found this video helpful, please let me know.